Hello guys, today we will be going over IB business management. So we're going to be solving the IB May 22 past paper, paper 2, which is the HL paper in this case. And if you have any specific past papers you want me to solve, please comment down below and like and subscribe to my videos, please, so I can continue on making more. So let's begin. So we have a product, we have to actually read the case first before reading the questions. So first we have this business called Rosgas. So Rosgas produces and sells sugar donuts. So monthly, so they have sugar donuts, right? Monthly fixed costs are 15,000. So this is fixed costs, very important. Monthly sales revenue is 70,000 and total variable cost per month. So total variable cost is 25,000. To increase its productivity rate, this is a key word in the syllabus, Roscas wants to buy a new high-efficiency machine that produces chocolate-filled donuts. The finance manager has forecasted the following information. So again, keep this in mind that we're following the 2024 syllabus, and these are all applicable to the new syllabus. Now, the productivity rate isn't like, let's say, a definition, but it is, we should know what it is, and it is in the book. So anyways, let us begin. So what is productivity rate? Because they want us to define it. Productivity rate is a measure of efficiency and can be defined as the rate of output to input production. Okay. And it's basically the manager may be interested in the productivity rate just to see how efficient the production is. So you can write that down, but I think that this is more clear cut. Then we can also, something that's very, like, they do this mostly in economics, not in business, but to show your understanding, you can add the formula. But first I'm actually gonna add managers are interested in knowing the business's productivity rate as it measures efficiency of production. And then we can continue by writing the formula. So productivity rate is equivalent to total output over total input times 800. So this is a perfect answer because it basically shows that you understand what it means and you talk about both inputs and outputs. Okay, so you have to make sure you mention inputs. You have to mention outputs. Okay, so here you mentioned output to input. So you have to make sure that it's all over your answer because these are the keywords for productivity rate. So here we can by defining. So once when you begin defining, you don't really have to look at your tables. But now we do because here they're saying using the information above and in table 1, calculate the total contribution per month for the production of 20,000 chocolate-filled donuts. So keep in mind, in IB Business Management, you really, really, really have to keep your eyes peeled for the detail. So here you have sugar donuts. It was sugar donuts. In here, it's chocolate-filled donuts. So just keep that in mind, right? And here it's for chocolate-filled donuts. So always keep that in mind. So anyways, to continue with our calculations, we want contribution. So I just want to kind of explain contribution. Contribution is basically contribution is what is contributed to pay for fixed costs. Okay, and the contribution per unit for the chocolate-filled donut is basically 5 minus 2, which is $3 in this case, because it's the price minus the variable cost per unit. What is the variable cost? The variable cost is basically what the business, in this case Roscas, pays to produce the donut. Okay, so it's what Rosca pays, and $5 is the price, is what it sells it for. Okay, so now we need to actually, because they want the total contribution, right? They want the total contribution. So first, there's several ways to solve this, actually maybe two, but I'm gonna solve it in the easiest and simplest way. And I just like something to be very direct and efficient. So we do contribution per unit. Okay, and this is B1. Contribution per unit is basically price per unit minus variable cost per unit. Okay, so then we end up having 5 minus 2 equals $3. And always keep in mind that you have to keep the dollar sign in your answer. And now we have total contribution, right? So basically total contribution is just contribution per unit, which we already calculated here, per unit, times number of units equals to 3 times, in this case, they gave us 20,000, which is equivalent to $60,000. Okay, so this is the total contribution. Again, contribution is basically what the business gains out of selling. So for each one they sell, they take $3, and usually they pay the contribution to contribute to fixed costs, right? And then we have number 2 for B, the monthly profit of Rosca sells. Okay, they want profit and they want sugar donuts and chocolate-filled donuts. So this is actually kind of intended to confuse the student to a certain extent. So basically, we need to keep in mind total profit is equivalent to total revenue minus total costs. Let's break this down just a bit more, right? Total profit is equal to total revenue minus fixed costs plus variable costs, right? So let us now do this. Okay, so we're gonna split the chocolate and the sugar donuts just so you guys can really get it. So here we have for sugar donuts, right? We have for sugar donuts, the total revenue, right, is 70,000. They gave it to us here. So here we put 70,000. Okay, the fixed cost is 15,000. So here we put 15,000. Okay, the variable cost is 25,000. So here we put 25,000, right? And then for the chocolate filled, it's all in this table. So we have sales revenue is 100,000. Okay, we have fixed cost is 1,000. Okay, so I forgot the dollar sign. We have variable cost per unit, right? And we know that we're selling 20,000 units, right? So what we really end up getting in this case is 2 times 40 times 20,000, sorry. Okay. 2 times 20,000 is 40,000, okay? So here we get 40,000. I should have technically done these in another color. Sorry, guys, my apology. But yeah, if you want, I'll just do it now. So I'll just change the color. But anyways, you don't have to do them in different colors. You won't even have time for that in the exam. But I'm just trying to get you guys to get the concept, because once it's in different colors, the human mind automatically just gets it faster. So this is really it. So what you end up doing is that you end up just adding these. So here you get 170,000, and here you get 16,000, and here you get okay, so we have 25 plus 40,000, which is 65,000, right? So here you get, so our final answer here is 170,000 minus, what's 16 and 25 plus 65. I'm guessing it's 81,000. I'm gonna guess my check. 16 plus 65,000 is 81,000. Yes, I'm right. So 81,000. So then we go further to just subtract by, oh, you don't have to show the number here, 81,000. And our answer is 89,000. So this is our total profit. Okay, got it. So this is how you calculate the profit. I think these two questions were quite easy. They were just trying to make you focus on the wording because they don't really test you just for the concept, but your focus and your word and like, yeah, just really your focus and your attention span. This is something IB really do, and actually every program does this, but you just have to keep your eyes peeled, guys. So now we wanna do the payback period. So the payback period, we actually have to focus on table 2. They even told us. So let's get to the payback period. Okay, so we have C, we have C1. So here we just do the simplest thing. Always, guys, when you get a payback period question, most of the time you just have to really just do this. So here you put year, you put net cash flow, and I'm gonna put in dollars because I like to include my zeros personally. You don't have to, but I just do that. Or you know what? I'm just not gonna include them just to save time and space. $0.00, and just to like copy it because once you if you try to add the zeros, you might just make a mistake, and I want you guys to avoid that. So just make sure you just follow whatever they do, okay? And that way you can have the exact same answers as them. Okay, so first you do year 0, year 1, year 2, year 3, year 4, year 5. Then you just begin. So you start by just putting the minus 2,000. It's 2 million, but whatever, we're just gonna like follow whatever they're doing. So guys, you just have to um keep in mind that I'm just gonna actually explain. So what happens is that they want to buy a new machine for increased productivity rate, right? Um, Roscos wants to buy a new high efficiency machine that produces chocolate filled donuts, right? Okay. So basically, Roscos ended up paying, so I'm just gonna use another color. So Roscos ended up paying 2 million for that machine, right? So it's cost them 2 million. But then the machine's gonna end up making them this amount of money because it's going to end up producing these chocolate filled cupcakes for them, and these chocolate filled cupcakes will produce revenues for them. So we need to see how much return they're going to get on their investment. So here we have minus 2,000 in the year 0 because this is just when they bought it, not when they began. Then the first year they made 600,000, okay? So they made 600,000. It's better to have the numbers aligned, guys, so the examiner won't think, or just like for the examiner to think that you're going in the right way. So now what you end up doing is that you actually end up subtracting this by this. What do I mean? So you do minus 2,000 plus 600, okay? Or 600 minus 2,000, okay? So then here you end up getting minus 1,400. See, so you added the 600 because now Roscos already had made 600,000 from this machine that they just bought, okay? Then the year after they made 650,000, okay? So then they have minus 750 now. And then in year 3 they end up making 670. So now they have minus 80. Okay? And then year 4 they end up making 700 and they get a positive cash flow at this point. So they end up making 620, which is positive. And then in year 5, they make 710. And just add 710 to 620, you have 1,330,000. So you return to 4-digit as well. So you can see they actually ended up making or regaining all the money they spent on the new machine because again, it's the investment. The goal is to make money. But here, this is not when you guys are done. So what you need to do in order to get your final answer, guys, and I just want to explain a bit because sometimes students are confused. So I want to just like get there. So you keep doing this, guys, okay? You keep doing this. And what does this mean? So for example, here you do minus 2,000 plus 600, so you get 1,400 minus 1,400. Here you do minus 1,400 plus 650, you get minus 750. So this is how you actually reach your answers, right? So now we're going to continue by actually just writing this calculation. Extra cash flow required okay, over annual cash flow in the year which it became positive, which is actually year 4. This is when we actually had a positive cash flow in year 4 times 12, just because we do have 12 months, so we have to multiply it by 12, so 12 months. And then here our answer will become, okay, our answer will become 80 because we do have 80 was required in the year before, right? So 80 divided by, okay, so I need the same color, divided by the cash flow in year 4, which is 700 times 12. So I'm just gonna make my calculations at this point. So we have 80 over 700 times 12. So our answer is 1.37. What does this mean? So we do know that at 3 years we have minus 80 left. So what does this mean? We mean that it's 3 years and 1.37 months to actually pay back for the machinery. So this is the payback period, okay? So now for question C2, which is the last question in this exercise, because this is part 1. I'm gonna do part 2 in the video after. But basically for part 2, we're going to be just calculating the average rate of return, average rate of return. I'm not sure if this is in the formula booklet, guys, so you need to check. But I just prefer that you guys know all your formulas, just because it really helps you understand the nuances. You don't have to memorize them, you just have to make sure that you know them, you know. It's basically understanding, but you have total returns minus capital cost over years of usage and then all of it is divided by capital cost. Okay, so I don't think this is letting me do this. Okay. Capital cost times 100, all of it's like times 100. So we get 3,330,000. That's our total returns, because we actually do know that these are total returns. How do we know that these are total returns? So guys, let's actually end up calculating total returns, right? So total returns is 600,000, because again, this is in 000. This is 3 zeros, so you have to add 3 zeros to each one, right? So just keep that in mind when you're making your calculations. So you do 600,000 plus 650,000 plus 670,000 plus 700,000 plus 710,000. Okay, so now you just end up adding everything, right? So we get $3,330,000. Okay, so this is your total returns. So here you have 3,330,000 minus capital cost, which we know in this case is 2 million. Okay, and then you divide by years of usage, which is, I guess, did they tell us the years of usage exactly? No, they didn't state it, so we're just gonna put 5. Okay, and then times 100. Oh, and then divided again by 2 million. Okay, or you know what, we can actually leave this and then just we multiply this by 100 first. Or no, we actually leave this for now. We calculate this using the calculator. So just give me a minute, guys, to just make my calculations. But guys, we just used 5 because they didn't give us any specific like time frame. So we just have to use 5 based on what they give us. Again, if they don't give you something, they don't give you something as specific as you wanted to, always use what they give you. So our answer is 200,666. Okay. This is our answer. So now we end up applying the full formula. So it becomes 200. So I'm just gonna like continue it here, guys. 266,000 divided by 2 million, because this was our capital cost, times 100. And I'm gonna just do my calculations once again, guys. So keep that in mind. Okay, so our final answer is 13.3%. And why is it in percentage? Because keep in mind, guys, always when you're, I'm actually gonna use another color that's darker, yeah. Always that when you have a time you're multiplying by 100, you always get your units as in percentage whenever you're multiplying something by 100. Now, I just want to explain what we did because I think you guys might have gotten confused. So we ended up calculating this first, which is this is our answer. Then we ended up continuing by just doing the rest later. So we did these later. Okay, guys? Like this is exactly what we did. So, and we calculated total returns. Here, okay, total returns, total returns. So this is really it for part one of May 2022 Roscas. I really hope to enjoy this video. And if you have any questions, please comment down below. Bye, guys. Love you guys. And please comment down below if you have any questions. Join my Google Classroom for more notes and please subscribe. Bye, guys.